Welcome back to another episode of Nick Knows Insurance. Today we're going to be covering one of the most hotly requested topics on this channel, which is how to decide if an HSA plan or a traditional PPO Copay plan is a better fit for you. We're going to break everything down in this video, so follow along. After graduating college, many of my friends were getting jobs with companies that were offering them a choice between more than one medical insurance plan. And almost all of my friends would say, Nick, is a PPO plan or an HSA plan a better fit for me? And honestly, the answer really depends on you and your specific situation, but for most of my friends, I actually recommended that they choose the HSA plan. You'll see why I made that recommendation, along with the pros and cons of each plan in this video. I wanted to do things a little bit differently this time and get the ladies at the office involved. So I'm going to have Nancy kick things off by breaking down what an HSA is. So follow along.
Let's begin by taking a closer look at the two main components that most people think of when considering an HSA. An HSA plan is made up of two parts, a high deductible health plan and health savings bank account, or the HSA. To keep things simple today, we'll refer to the insurance plan as the HDHP and the bank account as your health savings account. When the two pieces come together, that is what we'll call your HSA plan. To be a qualified HDHP, the insurance plan must have a minimum deductible of $1,350, and all services aside from preventive care are subject to the deductible. This means that your plan won't pay for any services until you've met your deductible. Once you have met your deductible, your coinsurance begins. Coinsurance is simply the cost sharing between you and the insurance company that you will both pay until you reach your out-of-pocket maximum. The combination of the high deductible and having to pay out-of-pocket for office visits and prescription drugs are what deter most people from choosing an HSA plan. However, the deductible and absence of copays can be offset with a properly funded health savings account. Because of the high deductible, these plans are generally less expensive than a traditional PPO plan. A health savings account is a tax-favored savings account designed to integrate with your high deductible health plan. Similar to a 401k or an IRA, HSA balances are owned by you and accumulate earnings on a tax-free basis. HSA balances roll over from year to year and are not lost if you change jobs or insurance plans. Both employers and employees can make contributions to your health savings account on a pre-tax basis. Health savings accounts also offer a triple tax benefit. The contributions are tax deductible, it offers tax-free growth, and withdrawals are tax-free for qualified medical expenses. The 2019 contribution limits for an HSA account are $3,500 for single coverage and $7,000 for family coverage, with an additional $1,000 available in catch-up funds for anyone age 55 or older. HSAs work best if you plan on consistently funding them. That way, in the event that you ever do have a major medical expense, not only will you be financially prepared for it, but you'll be able to pay for it using tax-free dollars. This also works great for expensive prescriptions, reducing the cost to you by using those tax-free dollars.
An HSA plan might be the right choice for you if you're not a heavy utilizer of your insurance, meaning you don't go to the doctor very often and you might only get a few prescriptions filled during the year. It's a good choice for you if your employer is making contributions to your health savings account. If you combine employer contributions with contributions of your own, it's an even better fit. By consistently funding your account, not only will you be better prepared for major medical expenses, you will also have funds in your account to pay for those few doctor visits and the few prescriptions you might need during the year. If you do have a large, unforeseen expense, you can still put funds into your account and use them to pay for the expenses on a tax-free basis. HSA plans work best if you plan on remaining on one for several years. This makes sense because it is highly unlikely that you will exhaust your funds each year if it's being consistently funded. The consistent funding and the fact that HSA balances roll over from year to year allows you to fully cover your deductible and potentially even your out-of-pocket maximum. The HSA can also be used as a supplemental retirement option because you can withdraw your funds without a penalty at age 65 for non-qualified expenses. Now that we have covered HSA plans, let's take a look at a traditional PPO Copay Plan. A PPO plan works much like you would expect a traditional insurance plan to work. For most of these plans, you will only pay a copay or a fixed fee for covered services like office visits, lab tests, and prescriptions. These do not contribute to your deductible, but they do contribute to your out-of-pocket maximum. Other than that, the plan works the same as an HSA plan. Once you hit your deductible, your co-insurance will begin sharing the cost until you have reached your out-of-pocket max. A PPO plan might make more sense if you or your dependents have frequent doctor appointments or are taking prescriptions regularly. In this case, a PPO plan would be a better fit because you're only paying a small flat fee for these services rather than paying the entire cost out of pocket like you would with an HSA plan. For example, if you are taking an expensive prescription and are on the PPO plan, you might only have to pay a flat $30 as opposed to the full $300 on the HSA plan.
Choosing which plan is right for you really depends on your personal circumstances. So do the math. Calculate the annual premiums, then add in any copays, prescriptions, or other expenses you could have throughout the course of a given year, and factor that into how that might affect your deductible, your out-of-pocket maximum, and your overall exposure in a given year, and use that to determine which plan is a better option for you. If you are a relatively healthy individual who only visits the doctor maybe a few times a year and isn't currently on any expensive prescriptions, then I think an HSA might be a good option for you, especially if that health savings account is being consistently funded. We'll take a look at the actual numbers behind these two plans, including premiums and what your total financial exposure could look like in a given year in our next video. So be sure to stay tuned. And until then, we'll see you next time.